go ahead and get started. Good morning, everyone. I'm Rick Mullins. I'm the Executive Assistant to the President at Central Connecticut State University, and I oversee the operations of the Institute of Technology and Business Development. I want to thank our sponsors today for this breakfast series. They're in their third year of their sponsorship. This is our 8th annual year of the breakfast series. And for those of you that are CCSU alums, this breakfast series was started by the CCSU Alumni Association 8 years ago, and we've been able to continue it with kind sponsorship from a number of different sponsors. TD Bank is a good friend and one of our alums. John Cookley is an SVP for TD Bank across the street. He can't be with us today. I think he is pleasantly in Florida where it's a little bit warmer, right, folks? We have a large staff of TD Bank folks here, and I would like them to stand. I'm going to read through the names. Carl Hines, Sheila Amaral, Jared Carey, Patty Hannon, and of course we have Mark here on our panel. Thank you all for your support. I'd also like to welcome the New Britain Chamber of Commerce and its new president, Tim Stewart, and his staff, Bill Carroll from the Chamber, who of course have supported this event. And you're going to hear a lot more about programs between the Institute and the New Britain Chamber as we continue to grow our relationship between the New Britain and Berlin communities, and I'm sure Tim's got great plans for expanding that in other areas. For those of you that aren't familiar with ITBD, we provide workforce development training, business conferencing space, as you see here, and business incubation and business advising services. And we have a number of our business incubators here. We've had over 80 business incubators to date that we've coached through the various stages of stage 1, stage 2, stage 3, and growth of their business. And it was with activities like this and people on the panel who are here today, specifically people like Chip that I've worked with, Jared Carey at TD Bank, Sheila Amaral, who provide us those business contacts, and Chip works with a number of the DBEs, the Disadvantaged Business Enterprises that we have through the DOT program, or the University Center project that TD Bank is a sponsor of. And for those of you that have been to our breakfast before, I'm sure you've seen how much they've improved with the addition of one of our key faculty members, Dr. David Fearon from the School of Business in the Management and Organization Department, and a Durant Fellow. David, it's great to have you, and we look forward to your leadership in the session this morning. I'm not going to spend much more time with introductions. I'm going to ask Dave Fearon to take over the program and get our folks introduced and get right on topic. I'll be back at the end for some concluding remarks. David.
I've seen Rick introduce sessions in people for years now, and he's always so generous in thanking people, but why don't we take a moment and thank Rick Mullen for his leadership and his managerial actions. Well, before we get started, I want to pose a little puzzle. So, I'm going to just ask you, what is this worth?
Today, I'm not sure.
Okay, there's someone who's already thinking along the lines. What is this worth?
I say straight up $5.
$5. And one more test. What's this worth?
Whatever anybody's willing to pay for it.
There. Now, our work is done. We don't need to have this session today. Because I think maybe because of who you are self-selected, I think we understand that the face value of things as common as our currency has everything to do with what a person wants to say it is. So this is a $5 bill, or it's a piece of paper that you can roll away and throw. I'm not throwing this away for anything. I don't get paid well enough to do that. I don't. But that's the point. Value is I think was, is, and always will be probably the central challenge and issue and question of business. Because we who produce have our ideas for what something is worth. We know what it costs us to make it and to market it. But if we don't get people who say, yeah, that matches my standard for this particular purchase, we don't sell, or we have to discount. So we have an ever more increasing reliance on the eye of the beholder. So I understand this panel, who are looking at this issue of value from several perspectives, can help us make sure that when we do step out for tomorrow's offering, whether we're offering to sell a business or ask someone to join us in investing in the future of the business, that we have a better idea of how to make a convincing case for this being $10. Not in fakery, but saying, you know, if you put this money down on this, then it could become, from the banking perspective, at least more than $5 if you put it into one of our plans, or if you invested in your life insurance. So that's what we're about today. So I'm going to ask each of our panelists to give a brief introduction and a bit of a, what do you think about this premise of mine, the $5 proposition? Starting with you, Jay, tell us about yourself and what do you think about the $5?
Sure. I'm Jay Rasmussen. I'm part of the Only Savings Company, Glastonbury. I'm a tax guy by trade. Most of my work is really done working with small business, family business, helping them transition, prepare that business for whatever that value may be somewhere down the road. And I think what I find many times is that business owners think their business is worth 5 to 10 times more than it really is. It's just the way it is. I mean, unfortunately, it's only when someone will pay you for that business. I think that's the point you were trying to make. You know, nobody cares what you put into it, the hours you worked. They want to see value when they pay for something. So again, my career started at Ernst & Young. Spent a lot of time in working with family, closely held business, transitioning those businesses, doing a lot of estate planning, basically holding the hands of business owners and family members to make that transition. I like to say a lot of my job is not even necessarily tax or accounting. It's many times it's just being a psychological counselor to family members in transition, which sometimes could be eye-opening. Many times you have family members, 2 or 3, when the business gets transitioned. You know, the buyer only wants to take one, so it's very difficult to explain to the other 2 siblings, sorry, you know, the gravy train's over, you take your money and find a job. But sometimes you have to sort of say, you know, be very blunt about it.
So when you have questions for Jay, recognize that he has to work on the realistic perspective. He has to bring people a bit down to earth, or in some cases maybe take them the other way. Maybe they've undervalued what they have. And Mark, welcome. What do you tell us a little bit about you, and what do you think about my $5 proposition?
Sure, thank you. Mark Wasilewski from TD Bank. Right now what I do at the bank is I run the group that underwrites and structures the deals that are brought in by the team, by the sales folks on the front lines. So when your deal comes into the bank and you're a relationship person, sorry,
That's just my charisma.
it must be because it's
Sometimes the street lights go out when I drive.
that's like Dumbledore.
Okay.
Very good.
So when your deal comes in, we're the folks that take a look at it and make sure it fits the right profiles and that, you know, we're going to get our money back and you're going to get everything you need from the bank. So when we look at a company and its valuation, we have very much the same interests that you do. We're providing senior capital, at least in our case at the bank. It's senior capital. Okay, so it's first in line on the credit food chain, and that's where we like to be as a bank because we are funded by policy, by deposits, by our depositors, and above everything, it's our job to protect the investments that are made into the bank by my mom, my brother, my sister, your mom, your sister. So, as a bank, we take a very conservative approach versus some of the other sources of financing that you may find out there. We're willing to take a little bit more risk. When we look at a company's valuation, and I think when when you're considering your company's valuation, one of the things we look at is the type of buyer. So you may have a financial buyer who has a pile of cash they want to invest and they want to get a return on that money. So their investment portfolio is yielding 7% at this point. They want to do something that's going to yield 15%. So they're going to take a look at the equity capital they put in there, net of the cost of the debt, and how much money your company throws off and what it's worth to them, and the cost saves and the things that Jay does, and discount that back at some kind of investment rate and arrive at a value. We do that at the bank all the time. There are asset buyers who just want your assets. They do the exact same thing that you do, and that's in a situation where maybe your company's at a point where that's where the value is. And then there's owner-operators who want to come in, and this is going to be their life. There are various ways to value those too. But as a bank, as a senior lender, we're looking for the same things that you are. So we're just valuing.
It's a nice segue into your introduction, Chip. Why don't you tell us a bit about your perspective, and what about that $5? I've already had to pay taxes on my 5 before I even got to the next panelist. Tell us about your work.
Well, by properly strategic planning, that 5 can become 10. Good morning, I'm Chip Janishevsky, and I'm an independent consultant. My background, I have an accounting degree, which I got BC before computers in 1976, so I used ledger paper, calculators, and the whole 9 yards to do the financial statements for my father's manufacturing company, which I worked for 20 years. We had a 70-man shop, a job shop out in Cheshire, and I took us from the before computer age to all the automated accounting systems and manufacturing systems by the time we sold the business in 1995. And by then I had been president of the company for quite a while and had generated all those systems. And I actually went through the process of doing the business plan, putting together the package to sell the business, and basically that's what we did in 1995. And in 1996 I was rewarded with my dad with getting the boot. And that's when I went into various different things, which I wanted to market through word of mouth. So a very strong side of me is the networking side, relationship building, because relationships basically drive the world, whether it's business or jobs or whatever. And I'm a specialist in training people on how to build their business or whatever by word of mouth. I actually run a networking group myself every month across 40 to 50 people in West Hartford, and do a lot of networking talks and things like that for chambers of commerce and that kind of thing. But getting back to what I do for ITBD, which actually I got into ITBD through a networking league, which was fantastic. Since 2008, I have been working with ITBD mostly in the DOT DBE program, as Rick had said, and I've taken a lot of businesses through this program, and the big part of it is helping them do their business plan and their strategic plan. And basically what my philosophy is you should always be running your business as if you were going to sell it. And back when I did the strategic plan and the business plan for my business, it was before we had computers to do that kind of thing. Nowadays, you can do your business plan in Word, you can do your financials in Excel, so that you can constantly monitor yourself. And what strategic planning, which is the biggest part of the business plan, is all about is here's where I am today, here's where I want to go, and these are the steps that I have to do to get there from your operations standpoint, which is your employees and that kind of thing, and then also from your business development standpoint, tying everything together with your financial projections. So basically what I do with businesses is I walk through that whole process, and if you're constantly updating your strategic plan because you have it in a Word document and you have it in an Excel spreadsheet, and constantly running your business and tweaking it, your business will always be at its highest saleable volume if you're working on it. So that when you get to your accountant, when you get to your banker, things are going to be going well for you. So that's my approach. Thanks.
So I hear from Chip is intense management. So I want to run back to you, Jay. It seems to me that sometime when you sit down with a client, they they're surprised with that point that they thought it was worth a lot more. Is there some spectrum that you've encountered, people who sort of run the business seat of the pants and, with hope and a prayer, all the way out to those who would be advised by people like Chip to be, very tight, use technology to give them a dashboard that tells them basically where all the vitals are? What's your sense of the person out there that
Yeah, sure. I mean, I agree. I mean, everyone should run their business if it's going to be transferred, not necessarily sold, but transferred to somebody. I always tell people I work with, clients and non-clients, I mean, treat your business as an asset. It's just another asset in your portfolio. Your salary is your salary, and you live on it, but your business is an asset. So it's important. I mean, everybody looks at, profitability. Every business is valued on EBITDA. I don't care what you say. It's some multiple of EBITDA, earnings before interest and taxes. What I use, and I think you have a handout on your table, it's a product called Core Value. It's sort of a quick and dirty, non-number-based valuation, which goes through 18 business drivers. I like it because it's very quick, it's efficient. It was developed by a bunch of guys out of MIT that basically concluded the business has these certain characteristics in HR, operations, marketing, barriers to entry, then they're worth X. So I find this to be a very useful tool that when I sit down with my clients and prospects to say, all right, you think your business is worth X, it's really worth Y, and here's the gap. How do we close that gap? And this process sort of bullets out for you, how do we close that gap in certain areas? So that's how I sort of approach it, in a quick and dirty way.
So when you have people go through that process, given that spectrum I just talked about, there are some where that gap is, oh my God, and others saying, well, looks like I'm there, or even possibly exceeding in some of those standards. How does that work, though, the psychology? Okay, I know there's a gap now. What's the next step?
Next step is to take the agenda items and bullet points and work through each item. An example I could use, I had a client about a year ago that had an unsolicited offer from a public company to buy for $14 million. We probably spent 2-3 months going through due diligence back and forth with this company. Finally, it came to the last week or so, and I usually tell people, the first offer you get in a letter of intent, it's not going up, it's only going down. So make sure when you decide.
That was just to get their attention, right?
When you get that letter of intent, you better be happy with the number because it's not going up. It will come down. And we had my client had taken a beating. I didn't necessarily like the way it was going. So I said to him, this is on a Thursday. Let's go through the core value process. Give me a couple hours of your time. Let's go through that process. He said, we'll do it Friday morning. We did it remotely. I wasn't even with him. We just did it remotely on a shared screen. Went through the whole process, gave him the reports over the weekend to sort of peruse through, and ended up being like a $21 million value. So there's a large gap. And ultimately, he turned down that offer because he just didn't think it was worth what he was being offered. And I think the core value process opened his eyes to, you've got a pretty good company here. You've got technology, you've got patents, you've got a management team that pretty much runs the company by itself. I mean, this guy spent 80 days a year in Florida while his company ran. He was making millions of dollars. Why do you want to sell it? Sell it, sure, but for the right price. So he backed away. So I think that whole process, it was a good investment of his time, I guess, to go through that process. And it opened his eyes to, I do have a pretty good company here.
It's a good news story. Mark, you mentioned a profile, and Jay just talked to us about another sort of way of profiling the value of a business. You're looking at it from outside in. Give us a sense of what that maybe optimal profile would be. When you look at it, you go, yeah, this is it. We're going to put senior money on this one.
It depends. I mean, if it's an existing business and we're financing it, it's typically a very different situation than if they're looking to sell the business or if there's a buyer. That's
Well, financing is part of developing the asset quality of the business. So we can look at it both.
Yeah, I think that's absolutely right. I mean, from the bank's perspective, again, we're looking at preserving capital. We're looking at preserving in repayment on the capital that we've provided to, let's say in this case, purchase that business. So taking from both the other folks on the panel here, our ability to realize value in the company is part of the underwriting process. I mean, there are often times where there will be, say, a cash flow multiple on the table that's being applied to the company, but the buyer comes in with projections showing that we're going to cut these expenses, we're going to add these revenue lines, and this is really what the company's worth, and as such, this is the leverage we're looking at, and this is the senior financing we're going to look at obtaining, or the total financing package we're going to look at for paying for this company. Oftentimes, the cash flow that they're looking at getting out of the company can be significantly more than the company's generating now. So, that's where the bank is going to do a tremendous amount of diligence in trying to understand how realizable those savings and those incremental revenue numbers are going to be. But if you're looking at the business just on a standalone basis, the bank can get very comfortable quite easily looking at your cash flow, the quality of the management, the sustainability of the cash flow, and translate that into the actual debt service and the capital we're looking at, and if the leverage is okay, and the delta between where you might get in trouble and where you are is where we make our decision.
That delta is an important figure then in our understanding today. Chip, and then, by the way, after a little bit more of this, I hope you're forming some comments and questions, because we don't have to wait to the end. But Chip, I'm thinking about the ambitious, dedicated entrepreneur, maybe incubates a business idea here or other places. And what I know of them, since I teach students who are aspiring to be in business, is that they are bold as hell when it comes to what they want to accomplish, and have sort of this, the money will take care of itself sense. And then they go to a bank who sobers them up a bit on that, and they look for more risk. People want to take more risk, but how do we get people actually from the beginning? You say run your business like you're going to sell it. How do we get people thinking from the beginning how important it is to keep that asset picture in their mind right alongside the world that they're going to save, or the new market they're going to break open? It seems to me that it's sometimes hard to get an entrepreneur to think both ways, because that kind of brings them down emotionally. Oh, crap, you mean I gotta have a cash flow here?
Yeah.
Talk about that a little bit.
How many of you folks have ever read a book called The E-Myth by Michael Gerber?
The E-Myth?
The E stands for entrepreneur, and I would highly recommend getting that book. It's been around for a long time, and Michael Gerber's built one heck of a great consulting company that teaches this around the world. And what it is all about, it starts out with the premise that there are three types of people, and we are predominantly one or more. The E, the entrepreneur, is the person who's the visionary, who looks ahead, and they're the ones that basically think that things are going to go from here to there and plan to do that kind of stuff. The second type of person is the manager, which is the person that runs things on a day-to-day basis, and if you change a system on them, they're the ones that go berserk because they just like coming to Saneville every day and running the thing. And then the third person is the technician. And the technician is the person who's doing everything but has the ideas and says, okay, right now I'm making money for the boss, but if I start a business myself, I'm going to be able to make all the money myself. Invariably, technicians start most of the businesses, and then they find out they have to be entrepreneurs and managers too. And so what the E-Myth does is it takes you through the process of stepping outside of the business, developing your purpose for why you're doing what you're doing, and then setting up your organization properly. And what I do with businesses, and this comes right out of the E-Myth, it starts with an organization chart. After you develop your purpose and where you're going and what you're going to sell and going from point A to point B. But the organization is exactly how you're going to accomplish that. And I put this together on a spreadsheet. And what it does is it lists responsibilities by department. And to me, there's 4 parts to most businesses. You have your business development side of things, you have your operations, and then your HR and your finance. And there's certain responsibilities that fall under each of those. And then what you do, the difference between an entrepreneur starting a business and a McDonald's and the 5% success rate and the 99% success rate is for your $1 million for your McDonald's, they give you the manual with all the how-tos in there. And once you have identified your organization, you can put the operation manual, which is your own franchise model, that defines all the systems that run your business, from operations to business development to everything else. And by doing that, you actually have something that if you take it to a banker to an investor or whatever, this is how I run my business, it's worth a lot more that way, but it also gives you the system of checks and balances to identify all the different parts of your business. So, basically, you have to look at the whole picture. You really can't do it by yourself. If you have, Napoleon Hill in Think and Grow Rich talks about the mastermind principle. The more people that you can talk with to help you out with this process, the better off you're gonna be having some good, strong people behind you. But that's really what it's all about, is starting out with a strong organization. And then again, coming up with your strategic plan, which is your operational strategy and your business development strategy that is tied together by your financials and your projections, and so that you can monitor yourself as you go along. That's what it's all about. So the more organized you get up front, and the more you have these systems to check yourself as you're going along, the easier things are gonna flow.
What do you think, gentlemen? Pick up on that?
Yeah, I guess, follow up to that, I mean, what I recommend, and I think it's very successful, is every business should have an advisory board, an outside advisory board. That advisory board could be a competitor who doesn't necessarily compete with you in this region particularly. Could be someone who's a specialist in your industry, and treat that advisory board as a true board of directors. Meet regularly and have an agenda which you're accountable to that board. I generally tell people I like to pay the board some number, not a lot, just something, only because if you're paying somebody, they tend to spend more time and be more serious about it. And there are a lot of people out there, believe it or not, who either work for a large company, own their own business, that actually enjoy being on advisory boards and have a lot of knowledge, have been through a lot of things that you as a business owner are probably wondering how they solve those problems. So that's one of the things I guess I took away from your talk is in any plan, I would recommend an outside board.
Yeah, I think that's part of when we're talking about organization, we're not just talking the internals, we're talking about where you're drawing your expertise. What do you think, Mark, do you want to pick up on that?
Sure, I think the thing that I take away from that is whether you're planning on selling your business or not, running at a peak efficiency obviously has its real world advantages, both for your pocketbook, for the success of your company, and for all your stakeholders. But just to put, and I think my job here is to put the bank's perspective on this,
Yeah.
is when we underwrite and we take a look at your company, whether you're selling it, looking for financing, whatever the case may be, we're going to look back 3 years at least. So if you have been running your company as efficiently as possible on an ongoing basis, we are going to be able to maximize the leverage, the ratios, the things that we will be able to do for you will be backed by the performance you've had historically, and it generates a lot of confidence in the company and the management when you're operating like that. So if you've been running for a few years and you implement this program 8 months ago, and then you go to the bank, there isn't going to be enough history there. While we'll see it as a positive, if you've been running like that over time, it's a much better picture than if you had just started. So I think, just strategically as you're thinking, and if you're looking for bank financing, and you're in a situation where you need financing, whether it be for working capital, liquidity, or for fixed assets, or for an acquisition, the longer you've been running at peak performance, the more flexibility you're going to have with the bank, and that's anyway.
We're at a point now where I'll continue to ask questions or pick up on things, but I'd love to have anyone who would like to steer this in a direction that would be important to you in the room to ask right now. I get the same silence from my students for a minute, so we'll just, yes, sir, there we go. Tell me your name.
My name is Darrell Wells, and I'd like to know how far in advance should a business owner consider succession planning for any given business?
Gee, that seems to be initially up your alley.
I mean, I like to say, you need at least 3 to 5 years in advance planning for any transition. But the sooner the better, I guess. There's a lot of issues that go into it. Structure, taxes, this whole system. So I like to do a 3 to 5 year window, and as a plan, that's sort of just keep that 3 to 5 year plan, moving, and hopefully
Or if you're not, what happens? Can you go to year 6 and?
Sure. I mean, again, the plan's gonna be constantly moving and being adjusted.
Right.
Nothing static, when it comes to a plan like that, but there are a lot of things that go into a plan. I mean, people come to me many times, 62 years old, wanna sell the business, their structure is wrong, they're a C Corp. I mean, it's too late. It's not too late, you gotta wait another 10 years to get this thing, structured correctly. The biggest thing I see, believe it or not, is there's still a lot of C Corps out there. I don't know why anybody want to be a C Corp. I think it's the worst structure you could have from a transition or a sales standpoint. And there's a lot of them out there still, believe it or not. So if you know anybody that's a C Corp, I'm not coming to see you.
Great question. Others? Yes, sir.
Hi, I'm Raymond Kokoza of Conveco Technologies in Bristol. I have a question about developing a new product. I guess the question's for the bank. When you're reviewing someone's financials, if they wanted to, there's two options, obviously, to take on debt to fund the development of a new product, or if the owner is fortunate enough to be able to do it out of cash flow and erode earnings. How does the bank view that?
So, it's a good question. When you're looking at financing, there are obviously different types of financing. There's equity financing, there's debt financing, and there's different tiers of debt financing. There's senior, there's mezzanine, there's angel investors. There's as you move from top to bottom, it obviously gets more expensive. Traditionally, banks are involved in funding fixed assets and liquidity, and that's a lot of what we do, right? We fund your working capital. Working capital turns, and the reason lines of credit are interest only is because you're turning your cash burn, you're turning your receivables, your sales, your receivables. It's a continuous churn, and we feel very comfortable with that because that's your cash flow. Fixed assets are longer term, and that's why we'll do a term loan for a fixed asset, because you're gonna get a return off of that machine or that building over time, and we're okay getting that money over time. And I'm getting there, I'm sorry. So when you're looking at product development, the ability of the bank to finance the fixed assets that go along with that, and this isn't cut and dry, but just to give you some thought, would be something that would be appropriate. However, when you look at the return horizon on R&D, it's very, very long. That's a product. And a rule of thumb when you're looking at financing is the shorter the return, the farther down you go from debt to equity on the financing scale. So at the top is working capital, very short, 1-year line of credit, we roll it every year, we don't need you to pay it back, interest only. As you come down the tier and you go longer and longer and longer, you move from fixed asset financing to perhaps a mortgage. A building has a very long life. As you get down to R&D, which is something that is inherent to the value of the company, develops a product you're going to sell for a very long time, we will typically support the fixed assets and the working capital aspect of that. But R&D is typically more, and you can argue with me, is typically more of an equity investment, because it's a long-term strategic move by the company to invest in an asset that's going to return over the life of the company. So we typically see that as equity. I'm not saying we wouldn't work with you to support various aspects of that, but R&D is typically financed, not senior debt. I think you could get a mezzanine player or an angel investor to come in, and angel obviously they want to take pieces and things, but as you move towards that return perspective and how long it takes to earn that back, you're getting down close to equity. Would we be interested in a part of that? Perhaps. Supporting the fixed assets that might help you do that? Perhaps, but it's typically an equity investment, and I hope that's in line.
Yeah, I think that I hear kind of in my head a real contradiction. I'm looking around, I'm looking outside into different a city, as Tim knows, and others who've supported the city for a long time, had a history up until fairly recently of product innovation. Not only from the bigs, the ones that left us, but a lot of people, in order to be effective suppliers, would come up with product innovation. And so it was a city that had a sense of we're willing to roll some dice. But then we had a recession from 07 up, and it seemed to me there's a lot of horns being pulled in. And to me, the paradox is at the very moment when Chip and we here who are stimulating, particularly the younger people or that technician to jump out and start to do something, we're smack up into a time where there's a tighter fist on, even angels aren't, flapping both wings that much. We had a panel last year. So what do we do about that? Chip, you're the one they come to you with big eyes and big hearts and a fantastic product, but they just heard it's gonna, if it doesn't start making bucks in, a year or so, it's gonna crash and burn. What do you think?
That's another good question, obviously. Basically, when I'm dealing with a lot of my DBs, I mean, a lot of them are in the situation where they're either really new, can't get financing and that kind of stuff. Obviously, there's, state programs and other things out there to help bridge the gap between getting going and then being able to be bankable and that kind of thing. But, again, to me, it gets back to the operations and, just researching what's out there as far as your options go. I mean, it's tough. I'm not gonna paint a rosy picture for people who are starting a business these days and say that there's, an alternate answer from the bank, because basically your goal eventually is to be bankable, so.
So I don't want to bring down the house here with bad mood here, but I would think though that if I were going to buy a business from one of your persons who, either I would want to know though that they haven't got a product that's shelf life is, getting down to the last hour. And wouldn't you want to say that part of the the valuing of the business is that there's something brewing there, that there's going to be something that's going to break through, Jay, and start really making some money. And then I guess that's a bit of a sales pitch because it is about the crystal ball. But I don't believe there's anything such as business unless we can use some of that kind of imagination. Otherwise, we're just sort of putting the lid on things. What do you think? I'm editorial.
Yeah, I mean, that's usually the biggest piece of any business is the goodwill. The goodwill is something you can't touch.
Yeah.
It's not a piece of equipment, it's not a receivable, it's not a fixed asset. The goodwill is really the future cash flow of the business. And what I would do many times is, there's a lot of people out there, baby boomers, who are looking to transition their business to someone else.
Mhm.
And there's no one there to take it.
Yep.
So many times you might be able to partner with someone like that, either to buy that person's business, just do something of that nature. That person may have some capital that, is looking for an exit, but not necessarily today. It's a 5 or 6 year process. And that person may be able to partner with you to maybe do some of that R&D. Because they're gonna know in 5 years, you're gonna buy me out, I'm retired, and you've got the business. So just a thought. There are a lot of baby boomers out there. That's the thing I found with this core value process, and the reason it was developed, is there's a lot of businesses looking to sell,
Yeah.
there's not as many buyers, unfortunately.
That could be an interesting frontier for our economy here in this region then.
Absolutely.
Is to tell some of our upstarts or people who are ready to, throw that long ball on a product idea or even a new service idea. Find someone to, tuck you under their wing for a while and help them, because my hunch is, since I'm well over that age, you don't want to be, you want to be in Florida. You don't want to be listen to some hotshot kid, say we could do something different here. Just let me run it out. But if you get that hot shit. It's hard to have a Maine accent and try to speak Connecticut. My tongue gets tied sometimes. So there's an idea. How about some more questions or comments? Yes, ma'am.
Hi. Hello. My name is Janet Johnson from FocusBusinessPlan.com, and I'm a business coach. And I was wondering how you felt or how you could see how lean continuous improvement, how does that help a company who wants to sell their business? I understand they need to implement 3 years out and show that it's working. But if you go into a company that has a lean continuous improvement program that reduces productivity or increases productivity by up to 40%, do you get excited when you go into places like that? Do you get this feeling that this is a company that's gonna move forward and be here for a long time?
Why don't we start with you, Mark?
Sure.
again, I talked a lot about numbers, and people probably think that banks are all about numbers, and while it certainly is very important to us, I can tell you, if not the first, often the first criteria we look at is the quality of management in a company. And there's a trust factor between the bank and the lender, the bank and the borrower. So the ability of management to effectively and historically operate the business well has a great deal to do with our underwriting and what we're looking to get and invest our depositors' money with. So a company that is continually improving and focusing on those is going to be, number one, paying very close attention to their operations, which is terribly important. The example of the guy who's in Florida 80% of the time, we have a lot of those borrowers, and I can tell you, I've seen some that are going okay, and I've seen some that are really not going well. So what I would take away as a banker from that would be a heavy and focused investment by management in the operations of the company. So yes, we would be excited about that.
I think the internal, very close attention to how processes are working and reducing waste is huge. But there's also a part about lean that I teach when I teach it, which is you work on having an acute relationship with your customers, one that you really feel, and you feel their pain and you feel their hope. So I would think another aspect, going back to the sense of will, is that there's some attention to how they are relating to their customers, current and how they're seeking others, but also are they turning those customer wants and needs quickly into new product upgrades, new systems. Would that not be a factor as well from this very nice question? What do you think, Jay?
Sure, I mean, lean in my opinion, is not an option, it's a necessary thing these days. But unfortunately, you can only be so lean.
Yeah, you
know,
skipped
can't-
all the waste out.
You need somebody to turn the lights on in the morning and run the machine, so you can
Yeah.
only be so lean. But what I've seen a lot is, a lot of lean operations, but they haven't adjusted their accounting system to be lean.
That's true.
Meaning they're not measuring, they're not focused strategically on what they're learning in the operations out in the shop. They're still using the old, cost accounting methods that don't match up necessarily correctly with lean.
So consequently, the purchasing is a little offbeat and other things. Yeah, that-
Well, they're making decisions not to do a product line based on their cost accounting method
Instead of what the
versus
customer-
looking at what their lean information is telling them.
Right. Anyone else want to pick up, Chip, you want to pick up on that a bit?
Yeah, getting back to a little bit earlier too, I mean, one of the things that businesses need to do these days is not only look at what they do, but how they're doing it as far as how they're presenting their products and their services out to the market, because there's different ways to do that. And obviously when somebody's looking at investing in a business, they're gonna be looking at the sales that they have, the customers that they have, do they have recurring revenue and that kind of thing. So, as an example, you have gyms out there and so on and so forth, where at the beginning of the year, they sign up everybody on a monthly subscription. And even though it's 50% of their people drop out by February, they're still getting that income until somebody decides to turn that thing off. If you can take a look at what you're doing and market it a little bit differently and turn that into recurring revenue, then that's a really important piece of the puzzle. But what David mentioned about keeping in touch with the clients is so important. I mean, client retention is based upon just calling people up or sending them emails or just touching them periodically, and I would actually track this. I would have your customer list and make sure you're talking to them all the time, because it's a whole lot easier to keep clients than it is to develop new ones. So if you can develop a system where it's a little bit easier to sell what you're selling and get recurring revenue in there and keep in touch with your clients, those are big pieces of the puzzle too.
Mark, when they're underwriting a business, you talked a lot about their internals and their history, but are you also including in your underwriting profile something about their customer, and potential of earning more customer loyalty and so forth?
Yeah, absolutely. I mean, diversity of the customer base, the concentration of the customers, quality of the customers, contracts, all those things are substantially considered in underwriting. And I just want to follow just very briefly on the question about R&D financing.
Yeah.
We see an awful lot of companies, but we have hundreds of companies in our portfolio, and thank you for that. It's great. What we do see a lot of is R&D is usually driven by a perceived need or a realized need, or a real and perceived. We have a lot of clients that partner client gets the benefit of a unique and specific product for their needs, and the provider gets to leverage the technology and the ideas to their broader customer base. So, banks aren't the only source of financing. I mean, aside from the typical payables, writing your bills, or whatever you're doing, there are real valuable and tangible opportunities within your client base to support those kinds of things.
So that notion of a collaborative model going forward with taking the whole concept of partner to a new level, not everyone has to pay for the whole thing then, and I would suspect that value has a lot to do with whom you're working. Question, Rick?
Yeah. Jay.
We can hear Rick, we don't need that.
Jay, going back to Ray's question, he's an entrepreneur, he's got a dynamic business, looking to make some changes in that business to bring that to the next level. When we talk about R&D in the state of Connecticut, are there some tax credits out there that, affect the bottom line in a little bit different way? If he makes that investment in R&D, or some places that he can actually treat that as a different form of an asset?
Yeah, I mean, Connecticut has some credits. Unfortunately, if you're an S corp, you're not going to get them. But yeah, there are a lot of incentive programs out there, both state and federal. There's the domestic production deduction, which is the federal deduction of 9% of your profit on manufacturing profit. And again, you just have to be aware of all the programs out there. But R&D's tough. R&D's tough because like bankers say, they can't see it, they can't touch it. You guys aren't doing any cash flow deals these days, are you?
We have very specific guidelines.
Oh, we're down to our last 12 minutes, so I want to get some more questions. Yes, ma'am.
Hi guys, my name is Catalina. I would like to ask you, what is one thing that you always say to your clients? So the one thing you always will be like, if I live today and you don't remember anything that we talked about, this is the only thing I remember. So I don't want to hear from Jay, Vermont, and Chip.
Cash is king.
Plastics. Develop that a little bit more, Jay, before we go on.
I mean, cash drives everything, unfortunately. I mean, that's the ultimately, any profit needs to be turned into cash, either taken out as salary or reinvested into the business. And a lot of businesses, especially industries like construction, cash is always tough because you make some money and you got to pour it back into the next project. So again, cash, well-capitalized company, which would mean cash. I was just talking to a construction company the other day. I mean, they're very profitable, and they're seasonal, obviously. But they know their cash goes up to $1 million and it comes down 500, 300, 200,000. It goes back up when the season starts. But their particular thing, they manufacture a product and they have their own trucks that delivers the stuff. And because they get slow in the winter, they've never laid off their drivers. So what they did is they went down the street to a propane company and said, listen, I got drivers in the winter who could drive your propane truck. So they actually have a program where these drivers in the winter drive the propane trucks to help the company down the street. So there's just, off the shelf, thinking different, how to survive, how to make a buck. You got to be a hustler.
And to stop burning that cash when it no longer pays off. Mark, did you have a thought on that?
If you're looking for a soundbite,
One word.
Yeah, it would be think long term. Period. Back to the succession planning and a lot of things we've talked about. Think long term.
Think about how that business, you want that business to be valued. If someone were to buy it the next day, that's a long haul. You have a question over here or a comment?
Hi, my name is Daishan Anderson. I'm what's known as Cards and Crack. I started my business with cash. Actually, I started my business with only $4,000, and I started my business in 2006. I'm still kicking. And, thank you. I haven't applied for a loan, and I've actually been doing pretty well. But I want to grow. I feel like I'm at a standpoint where I want to expand with particular partners. What do you recommend? How do you think I should start?
Anyone? Take it to the next level?
Sure. I can speak for the bank. I mean, the bank has people like Patty and Jared and Tommy here today that can talk to you and help you with that process. And that's a large part of what they do. And then the advisory folks that are sharing the table with me here today also provide those services. I certainly won't speak for them, but there are plenty of folks here that you can talk to today about what types of finances may be appropriate for your business.
So he's got a track record now too.
Exactly,
Which
yes.
makes a big difference, that we're hanging on and putting blood, sweat, and tears in, I'm sure, you reached that point, which, again, congratulations. We have time for one or two more questions. Yes, Tim?
Hi, Tim Stewart. I deal with a lot of small to medium-sized businesses throughout the communities that we serve, and a lot of them are in this gray area where they're looking for growth, but don't really know how to get there. What are the things that they should focus on before they come to see you, Mark, looking for money for these expansion opportunities that they see as a long-term goal for their companies, but not sure if they can get there?
So what I guess I'd stress in that case is find a banker that you like and that you're comfortable with. And bankers are advisors. We should be part of your overall strategy and your thought process. So my suggestion would be to find a banker that you're comfortable with, that you trust, that you respect, that someone and anyone here from TD I can highly recommend would be the person that you want to sit down and talk to. And bankers understand the entire spectrum of financing opportunities. We offer a specific band of that, but we can also talk to you about other types of opportunities and help guide your process and your strategy and how you could get there. We can also provide creative solutions. I mean, there's a situation, that came to mind while I was sitting here. While we don't directly finance R&D, you may have an unencumbered real estate property that your company is in that, has sufficient equity in it to pull out some funds that can finance growth, as long as the underwriting metrics support it. So,
I think though that Tim has put his finger on, our economic future long-term. The good news is there are still a lot of small businesses wanting to move to medium. The not-so-good news is that there's a point where they can get stuck. And if they can't break through that next level, as we just heard, then there may be, that's the sell-off time, or that may be the time when we don't hear about it anymore. Jay, how have you seen some of your clients, particularly after they've taken that reality test, figure out they need to do something different and then break through?
It's tough. I mean, the economy hasn't helped. You certainly don't want to sell your business or transition it when it's flat or down. So you want to hang in there.
It's a fire sale.
Right, exactly. You want to get your house in order. You want to keep things, orderly. Make sure your legal documents are set, your finances are good, you're accounting for things on a more regular basis. Talk to other business owners, maybe in your industry or out of your industry, what they're doing, what they see. What I see as a hot thing now is, anything technology related, especially web-based. I think at 14, 15, you're going to see a lot of transactions. You're going to see a lot of people like Apple buying up technology like that because they need some new products. They've got money. So that's what I'm seeing anyways. But you got industries that are just tough. Manufacturing, construction. I mean, you're not gonna blow the socks off, a construction or manufacturing company in this anyways right now. You'll make some money, but you got to be prepared to bunker down, get back to the cash flow issue. Make sure you got proper cash flow. Make sure you got proper capital.
It sounds to me a little bit like, we have some of the freshmen coming into the world, coming here, incubating. By the time they're seniors, they've learned what you said. They've learned some of the hard facts of life. They also continue to make it after graduation because they have tightened up and become more thoughtful and organized. At least that's
you were around in 2007, 2008, you're still around today, you're probably one of the few businesses that are doing well.
Right.
So
Keep doing it.
proud of yourself. Right.
We have one more question back here, and we're
Chip,
almost at our time.
I'd like to hear Chip's one, we didn't get Chip's one word.
Okay, all right, Chip, you've been working on that
And then
word.
another thing for Chip also.
Okay, after the one word, Chip, he's got one more
What was,
question.
what was the exact question again?
What I said is like, it's not one word, what I said is like, one thing you can say to your clients, like if you don't remember anything that we had in this conversation, one thing you should do for the rest of your life. For this business.
One thing you can say to your clients, thank you, how can I help you more? I mean, one of the best things that you can do for your clients is to help promote them also. You know, that's part of the networking thing, but if you appreciate your clients, ask them more how business is with them, maybe do a little bit of research as far as who their clients are and so on and so forth, and maybe suggest, maybe I can introduce you to somebody. If you can help your client out that way by helping them grow their business, you're gonna have a client for life as far as that goes.
So
So
keep
it's
seeking
all-
help.
It's all part of, you know, make your clients your strategic partners, moving ahead. I mean, we're all in this business world together, and the more people you have, you know, working collaboratively with you, and clients are number one because they already know you and they're already happy with what you do.
We've got the last follow-on here, and then we'll wrap up.
I'd like to, I know you've worked with a lot of strategic plans in Daishan also. What can you give him a bit of advice on his question? You know, I know that you've worked with him on his strategic plan, business plan and things, but what do you got for him?
One of the most important things is to keep your pipeline full. So these days, what you gotta do is really do work on, as far as part of your strategic planning, it's identify your target markets and identifying by name the clients that you want to reach, and those are the people you ask for at networking meetings. The more you can work on that and really project that to the people that you're working with in a really organized networking atmosphere, the farther you can go. I mean, I have the philosophy that even though, quote unquote, things are down a little bit, there's plenty of abundance out there for people who will identify, go out and network their way into it and get it. And that's, you know, that's what we're in the process of working at. And there's different ways to do that too. So, the internet is your friend. You spend a little bit of time in personal and business development and put that into your calendar. Make sure you keep doing that no matter how successful you are. Then your pipeline's not going to dry up. And if you have the relationships and the strategies to keep working with your clients and your vendors and that kind of thing, things will go well.
So we're gonna let that be Chip's last word. But Mark, last word for you, for us, as we're wrapping up here now?
Just thank you for the opportunity. Feel free to contact me as our contact information. It's on here. We all set for that.
I think we've put that on there. What was the name of that bank again? 2 letters. And Jay?
Yeah, just a quick follow-up to this gentleman's question about, you know, looking for partners. I would talk to accountants, attorneys, and bankers. And, you know, we as accountants, bankers, we have a lot of people that we know, a lot of clients that we have, and be very concise, you know, present the opportunity when you get a chance to talk to them, and they may know somebody who may want to be interested in partnering.
One of the huge benefits for us being Central Connecticut, based here in New Britain, but being Central Connecticut, is that a lot of people know a lot of people, because we're not churning and turning the population as you might find in a Boston or New York. So use that as an advantage, and the more people you know, the more possibilities there are. You'll find that attorney, that banker, or that accountant, or that entrepreneur, and you make something great happen. I want you to join me now in thanking a fantastic panel.
And of course, David, thank you so much for the wonderful job that you do for these breakfast series. It certainly brings a dynamic to the breakfast that we haven't had before. You know, Jay, you just brought up a good point, who to talk to. At many of our networking events, we have a lot of regulars that show up on a regular basis to our golf outings and our client appreciation days, and they are bankers, lawyers, attorneys, and our alums. Today we have at least 2 of our incubator companies here. One happens to be an alum, the other happens to be a student. Would you guys stand up? Because I'd like people to see who's here incubating their business. Conrad is one of our student incubators. He's doing very well. Jack Crowley, JC Specialty. Conrad has Banker News upstairs. Very dynamic company. Jack's been with us a long time. Thank you for coming, and I hope that you found this informative. Secondly, to your point, Jay, bankers in the room, stand up, if you would. All the bankers. These are our people from TD Bank, particularly here today, that have supported this, but they're local, and you can get to them right across the street, up West Main Street. Make sure you stop in Carlisle Hines. Raise your hand, Carl. Carl is on our advisory board. So, Jay, when you talked about an advisory board, you can sit down, thank you. When you talked about an advisory board, we have an advisory board at ITBD that's made up of roughly about 20 business professionals and 10 folks from the university in our various schools. We meet quarterly, Carl's at all the meetings, and we discuss the kinds of things that go on here in this session today to try to help your businesses and actually work with the state to bring some of those incentives, those tax incentives you talked about, Jay. Third, the attorneys in the room, please stand. Evan Goldstein, Bill Wilson, Miller Zachauer. These are folks that have worked with a number of our clients on a number of different types of business issues. You guys can say thank you. But these are folks that you see at our events on a regular basis and are engaged in our activities, and it's important for you to know who they are. And let's go back to one of the early points we heard here. Relationships. I think it was Chip that talked about the importance of the relationship. You don't build a relationship when you're in a crisis. You build a relationship before the crisis. You build a relationship by attending these networks activities, talking to your banker, informing them of your plan and of your needs, and your attorney reviewing your contracts. And your accountant. How is this fiscally going to impact me? On the asset side, on the revenue side, on the liability side, on the tax side. Build those relationships early. I did work for KPMG. That was the most important part of the firm, was the protection of the relationship between the client and the partner. Jay, in your accounting firm, I'm sure it's the same. That's where the real gold is made, by that relationship. Doc Fearon opened up today's session with a question, what's it worth? I heard $5, $1.50, $10. Well, it's about economics, supply and demand. And I learned from my experience that when you are an asset and when you help people move things along, it's never about the dollars. It's about the relationship and your ability to help them solve their problem. Because the dollars do take care of themselves. I think our bankers would agree with that. Our accountants would agree with that. If you have the right relations, and our consultants. So I do say relationships are definitely critical. I hope that you found today's session pragmatic and practical. One thing you'll find by coming to these breakfast type series, you should walk out with a gold nugget. I'm so glad you brought that up. What's the one thing you should remember when you walked out of here today? Or you walk out of that networking session? Or you've sat with that advisor, counselor, attorney, accountant? What should you remember? Finding and retaining the gold nugget. The one thing that's going to make your business different tomorrow than it was today. The importance of the strategic plan and the business plan. And one thing that didn't come out today that I think is very important as part of that is understanding the value of your business on a regular basis. Not when you have a partner that is leaving the firm, that has got a marital issue, maybe a death. It's too late to then make that assessment. On an annual basis, when you're looking at that strategic plan, engage us. We'll be glad to help you. Miller Moriarty is one of the accountant firms here too. I failed to mention that, John. Thank you for all your support. But these are the things that I hope you find valuable to running your business, growing your business, hiring our students, helping the economy of Connecticut.
Now you're talking. I was waiting until you said something that made me go.
And of course, you can't forget the faculty that provide all the wisdom and guidance to those students that help them move along. So I want to thank again TD Bank. I want to thank the staff here at ITBD, Cindy Walker, Gina Montano, Sue Davis, and Jim Brunner. Gina's one of the new ads to downtown. Gina, wave your hand. She was doing the registrations. Thank you for your help. Dr. Fearon, I can't say enough. It just has made our breakfast session so much richer having you here, and I appreciate your willingness to do that. And as I mentioned earlier, this whole process started at the CCSU Alumni Association 8 years ago. And the Director of Alumni Services is here, Cindy Kayer. Cindy's in the back of the room. Thank you, Cindy, for your continued support and that from the Alumni Association. I hope that you all have a great 2014. And for those that work on the fiscal state calendar, June 30th, July 1, a great FY 16 will be right around the corner for you. Please continue to look at our website for updates on events like this. We have 2 coming up. On March 5th, the nonprofit session will be on marketing and social media with 2 of our administrators at the university. It's free. Check the continuing ed website for that. Krista Sterling is a person to contact. And our next executive breakfast series will be on April 24th, and it will be about the Affordable Health Care Act. So if you're a business owner, this is going to impact you. There's no question about that. We've had some delays. Good thing we didn't do this one in November. There wouldn't be much to talk about, but now that it'll be April, we will see some progress, and we will have somebody from the Insurance Commissioner's Office here to talk about that. So thank you all very much. It wouldn't happen if you didn't show up. We appreciate your attendance. Please spread the word, and we look forward to seeing you in April. Thank you all very much.